Hello and welcome to Indianomics. On Tuesday, the Reserve Bank reduced the amount of capital that banks need to set aside to give loans to NBFCs and microfinance companies. Immediately, the cost of funds for NBFCs and MFIs falls, but the bigger message from the loosening of rules is that RBI seems to be determined to do everything to spur growth. Look at the sequence of events in the past quarter. First, on December 9th came the CRR cut, which brought in 1.13 lakh crore immediately into the system. Second, since Jan 1st, the Reserve Bank has infused 1.38 lakh crore by buying bonds through the open market operations, OMOs as we call it. Third, it started daily repo operations since January 15th to give banks temporary liquidity comfort. Fourth, it has done $5 billion of FX swaps in January and is doing another $10 billion swap on February 28. Together, they will infuse 1.3 lakh crore into the system. That's a liquidity increase. That's on the liquidity increase. On policy, we got the first rate cut, the first in 5 years, on February 7th, and finally, earlier this week, as I just said, lowering the curbs on loans to NBFCs. Now, separately, the Reserve Bank has also reduced prepayment penalties, and that can spur in its own way MSME borrowing. So now the big question, is all this enough to spur bank lending? More importantly, is it enough to spur growth, and will economists now increase their GDP growth forecasts for FY26? What more can RBI do? I have with me an elite panel, Mr. S.S. Mundra, former Reserve Bank of India Deputy Governor and former Chairman of BOB, now Chairman of Samman Capital, of course, Chairman of VSE as well. Suresh, Ganapathy, the finance company's expert from Macquarie Capital, and Nikhil, Gupta, the economist from Motilal, Oswal. Gentlemen, thank you very much indeed for your time. Mr. Mundra, to you first, sir. A huge set of policy announcements, but most important is the last one, that the NBFC loans will now cost less. Do you have a confidence that Reserve Bank is going all out to improve credit growth, or should we look at it as a very incremental step? You know, if you can wear your DG hat, the NBFC's loan to NBFCs was growing at 30% in 2023. Now it has come down to 7%. We are happy, we have changed. This has got nothing to do with overall policy reset. How should we look at it?
Okay. First of all, Latha, I would look at it like this. Probably to my mind, at least I don't recall a series of events. It will be one of its points that the risk weights have been increased and then they brought down within such a short, window frame of the time. Normally, this kind of action is taken. It remains for quite some time, and before the things settle down. So, at least you may correct me, but I don't recall. So it means quite clearly the data points which are available to RBI and also the data points which are publicly available, there had been a sharp deceleration. RBI is surely, I think, looking to boost the growth. Okay. I look at it like probably the first action was kind of a message to the lending community. Lending community has responded to that message, as we can see from the data point. And now that action is reversed. So probably with the expectation that a message has been conveyed, and now this message would be kept in mind in the future behavior of the lender. So now it is for the lending community to stick to the discipline which has been brought by this. Mm-hmm. But coming back to the point, now with this kind of change in risk weight, I think around 40,000 crore of capital would be released, which can translate into 4 lakh crore of incremental lending. And now if you look at the other measures of providing the liquidity, because, okay, if you have the capital, but if you don't have the liquidity, then the end result would not be the same. So it's a combination that the capital is made available, liquidity is made available. Key question would be, to my mind, whether this incremental lending would go to the productive sector or it will go to boost the consumption. Okay. Nothing wrong in either way, but again, I think the lending going to productive sector is a more welcome situation. But then depends on what kind of demand is coming, what kind of confidence level that sector is looking at it.
Okay.
Consumption growth is fine, only the precaution, it should not again, result into making the people over indebted.
Yeah.
Which has its own set of problem, and then there could be in the federal system, there could be actions by other players which we have already seen.
That's
so
true,
I
sir.
stop it here, but
Okay.
this is how I look at this big
No,
picture.
fair point, sir. Actually, to be fair, the Reserve Bank has not reduced the risk weight on unsecured loans. They're very correctly giving a message that NBFC loans need not suffer anymore because NBFC sources of funds appear to have gotten more balanced. It was too dependent on banks. Now they have kind of corrected it and depending more on market. It seems to be the spur to consumption, at least I can't see it. They've still kept the cork on unsecured loans. But Suresh, for a more immediate, reaction, do you think we can see NBFCs as the biggest beneficiaries? Their margins improve and their loan growth improves. Can we come to that conclusion?
Yeah, look, all these things will take time, Latha, to play out, right? It's not going to be quite immediate because of the fact that the liquidity in the current markets are still pretty tight. So nothing is going to happen before the end of this financial year. And then, of course, you start off on a weaker footing on April to June because seasonally it's a pretty weak quarter. So all these things will take time. A point which I would like to just drive across on this 40,000 crores and 4 lakh crore number. Look, I mean, this is all notional calculation, right? See, at the end of the day, you have to understand that the system common equity tier 1 was already running at 13.5%. This only adds an additional 20 basis points, theoretically, right? You can anyways go down to 12, 11% and could have lent that money. The bigger problem is that of demand and not of supply, to be very honest. At this point in time, the RBI is doing whatever it could do. From the supply side angle, we really need to see demand picking up. And for that, we have to see what could be the implications of the tax cuts and how exactly the overall market responds to that. So of course, at the margin, the NBFCs get the relief, but I would not really immediately pencil in growth numbers coming into the financial statements for either banks or NBFCs in the immediate future.
Well, Nikhil, question to you is that do you see all this as a concerted policy push towards growth? And therefore, are you changing your opinion, if not your actual number, on growth, say, 3 quarters down the line?
All right. So, no, I'm not changing my growth projections as of now. And I would also want to point out that, yes, if you look at all you mentioned at the beginning of this show, various steps that the RBI has taken, but we also need to understand that what happened recently is a part of the entire sequence. And you rightly pointed out that they have not touched the risk weightage on unsecured loans. Right. So this is a very targeted measure. They want to provide probably some relief to NBFCs and MFIs, which are too dependent on bank, and especially for non-PSL borrowings. It is PSL was never into the rate weights were risk weights were never changed for PSL borrowings. So it's only for non-PSL, and they are still keeping those unsecured risk weightage what they were revised to in November 2023.
That's right.
So it more looks like a targeted measure where they want to probably provide some relief for NBFCs and MFIs, not definitely to boost GDP growth or to boost the consumption-led loans. Overall, it is possible that all these measures may allow some extra room to the NBFCs and MFIs to lend out more. But again, if anything, it would be only incremental because I don't think NBFCs were too tight on supply front. They did not have money to lend to the borrowers if there was any demand. Because again, when I spoke with our NBFCs analyst, he was very clear that when in November 23, these risk weights were increased, the impact on NBFCs in terms of their cost of borrowings was not very significant. And if that is so, now when those risk weights have been reduced out, the impact would again not be so significant. So I'm not very sure if I would take it as a sign that credit growth is going to be much higher than what we were expecting.
So Suresh is not raising EPS estimates and Nikhil is not raising growth forecasts for the coming year. But why speak to an analyst, Nikhil? We have here a person who has lent loans as a banker and is still supervising an NBFC, which is lending loans for housing finance companies. So, Mr. Mundra, how will a bank chairman or a bank MD or a NBFC chief look at the sequence of events? Will they press on the accelerator and lend more because they see policy in favor? Or do you think that the reality on the ground, I mean, you would know better, is the reality on the ground not such that loan growth will necessarily increase?
The NBFCs continue to remain an important cog in the wheel as far as the last mile lending is concerned. And I think for a variety of reasons, banks had also been finding it a good vehicle for their overall credit growth to keep on accommodating the NBFC, which has quite constrained, as you can see from the recent data point. So while I don't think that suddenly it will create a huge kind of enthusiasm that you just open the tap for NBFCs, NBFCs would also not be expecting that. But I believe that from the point where we are at this point of time, probably there would be a more benign attitude in accommodating NBFCs for their credit needs. And NBFCs would have that capacity, while Nikhil has mentioned some point of time, but I think is a diverse field. There are many players, but I think it will enhance their ability to little push up their credit. So on both sides, on the bank's books as well as the NBFC book, I won't say it will be something revolutionary or something that suddenly a great change will come, but there would certainly be an incremental positive move from this. This is what my reading is.
Okay, point taken, sir. The other step that the Reserve Bank announced is that prepayment penalty will not be imposed on MSMEs under 7.5 crore loans. That will allow easier loan shopping by the MSMEs. Will these complex of steps, liquidity, rate cut and risk weights, create animal spirits in the lenders? That's the question we'll ask our guests after the short break. Welcome back to Indianomics. The Reserve Bank has announced a bunch of measures to spur growth, and we have been speaking to Mr. S.S. Mundra, former DG of the Reserve Bank, Suresh Ganapathy, Managing Director, Head of Financial Services, Macquarie Capital, and Nikhil Gupta, Chief Economist at Motilal Oswal, on whether growth and EPSs of finance companies will see a boost. The answers so far have been from all our three experts. Well, not so much. The key point is that people lend when they sense that policy is a tailwind. The animal spirits come up. So that's the question I want to address now. Mr. Mundra, in that context, this prepayment penalty being waived, until now, this is only a draft rule now, but what the Reserve Bank has done is that, of course, there is no prepayment penalty if an individual like me prepays her loan, but MSMEs were not included in this. Now MSMEs up to 7.5 lakh crore loans will not be punished if they do a prepayment, which is very good for them because then they can do some loan shopping. Go to the lowest lender when they see one. Do you see this as a big step, a good step, or a confusing step?
Okay, Latha, just before the break, you were associating the waiver of prepayment penalty with the growth. To my mind, there is no direct correlation between these two.
Okay.
I don't think it has anything to spur the growth. Yes, certainly is a move towards the fair practice. But to be very frankly, I'm little confused and surprised with this latest set. Of course, these are the draft regulations. And of course, it is with a disclaimer I am mentioning because RBI may have good reason to come with the draft which they have come with. They have a better access to the data point and the more nuanced breakup within the industry. But to my mind, any regulation should, at least three things should be there. It should be principle-based, it should be consistent, and it should be non-discriminatory. Somehow, from the basis of all the information which is publicly available, I'm finding that this draft is falling short in all the three categories somewhere or other. is a long discourse. But I would presently only cover why I am talking about the principle base. If time permits, I will talk about the consistency and not discriminatory as well. Now, see, why prepayment penalty is levied? What is the principle? Let us understand. There could be two situations. One is time mismatch. In the sense, if I give you a simple example, that as a lender, I source fund from somewhere for a particular duration and lend to someone for the same duration. And if someone is prepaying, then there is a ALM mismatch, time mismatch is there. Real life, it doesn't happen because it's a moving pool. Lender is collecting money from various places, lending, and banker's job is to really arbitrage on the time. You borrow short, you lend long, and you earn the spread. So principle-wise, that issue is not involved here. But the second issue, why prepayment? Because in a loan which a bank has raised the money on a particular rate and then lent and earn a spread. Now, if it is prepaid, they are required to redeploy it. There is a possibility that redeployment could be at a lesser rate than what was the loan which was prepaid, and bank is tend to lose. But that is where why it is not exempted on the fixed rate loan and on the floating. Because in floating rate loan, even if loan would have continued, the borrower would have been benefited by the reduced rate of interest as a principle. And that is why on a floating rate loan, this waiver, that is the principle. So principle-wise, is fine. I mean to say this is how. But what I'm trying to say, the principle is equally applicable to all kind of borrower. The situation which is there for an individual or for a MSC up to 7.5 crore is equally true for a MSC which is above 7.5 crore or for a medium enterprise or even for a large borrower. So that is why when it is applied selectively, somehow I feel is not, then is not completely principle based for all the category of borrowers.
Let me come to the other two gentlemen also to get their views. Suresh, I would think that this also helps good loan shopping by the MSMEs. I agree that this is not as revolutionary a step. It was more intended for fair practices. The NBFC rule is bigger. But do you think an NBFC lender, say an Umesh Revankar or the Rajiv Jain of Bajaj Finance, would now get the view that there is a tailwind behind us? RBI is on our side in terms of growth. You don't think that spurs animal spirits?
No, on the contrary, it's a headwind for them because remember that a lot of banks were not charging some of these prepayment penalties, and the RBI has very clearly said in the circular that the supervisory audits revealed that the policies were quite inconsistent across several organizations. That they were charging prepayment penalties. So what exactly happens is by doing this, you're reducing the switching cost. So for example, without taking any NBFC name, say an XYZ NBFC, which is maybe a AAA or a AA rated NBFC, was intentionally imposing a prepayment penalty so that the borrower didn't want to go to a bank. Now, of course, he cannot enforce that, and therefore that guy shops around and goes to a bank, right? So therefore, the NBFCs will be pressurized to reduce the rates. And I do agree with Mr. Mundra that this has no growth implication as such. This is obviously a benefit being given to the customer. On the contrary, there will be pressure on two line items because of this, more so for the NBFCs because they are the ones who have been charging some of these prepayment penalty rates and foreclosure charges on many of these floating rate loans. So the pressure will come in the form of lower margins because you will have to reduce your rates competing with the other banks. And the second thing would be in form of fee income because that foreclosure income will no longer be there. So it's actually bottom line. It may not be very significant, but definitely affects.
Sorry, probably I didn't phrase my question properly. My point was that including this and the other steps, will an NBFC take home the view that the Reserve Bank is now pro-growth? Will that sentiment, I'm a great believer in this concept of animal spirits. It's not often the dynamics of the economy, but the sense that, this is a good time, that normally spurs economic growth. Nikhil, your thoughts? I'm not referring to any specific instance. I'm referring to the whole ecosystem of sentiment created by the Reserve Bank from the CRR cut of December 8 up to this NBFC risk weight. Do these complex of events, create a kind of an animal spirit spur for lenders, both bankers and NBFCs?
Yes, Latha, so definitely this is a reversal of what we saw a year before December 24. And that is definitely positive for all the lenders, NBFCs, banks, or MFIs. Does it lead to animal spirit? I think that would be probably stretching it a little bit. I mean, whatever the RBI has done, we also need to consider some other factors that are there, which we know for a fact. For example, I was looking at loan to deposit ratio or credit to deposit ratio when I include loans and investments of banks and look at it as ratio to deposits. We know it was on the minds of the policymakers, and now when I was looking at this data, it is close to all-time high. So it has slightly increased from what it was a year ago, and in conjunction with rising LD or CD ratio of the entire banking system, we have seen that the liquidity deficit has also widened in the past few weeks or past few fortnights.
Okay.
So if you take home the conclusion that all these measures are going to push credit growth, then we need to be very clear about where do we want loan deposit ratio, credit deposit ratio to be, what would happen to liquidity deficit, which the RBI has been trying to control or bring it in line, or trying to keep it moderate as much as possible using various tools that it has at its disposal. So just because you have done some things, and again, I want to highlight they have not changed risk based on unsecured personal loans, which is a very big thing for me, at least as of now. I do not take it as a very clear signal that the RBI is all out to push credit growth in the country, to push it higher. On the other hand, they are definitely not as tight as they were a year ago, let's say 2024 entire. Since December, things have changed. But would it lead to higher credit growth? Would it bring back animal spirits? Probably stretching a little.
Okay, all right, fine. Then I probably got carried away in my enthusiasm. Some steps have been taken, but it doesn't go a very long way. And I would really be on RBI's side if they do not reduce risk weights on unsecured loans just yet. The kind of stories we are getting from both MFIs and unsecured loans, credit card loans, is not very positive. As a regulator, I would be worried. Mr. Mundra, the last word is to you. Let's end it on that prepayment penalty note that you wanted to say. We have a couple of minutes. What would you want the Reserve Bank to do on this issue?
Yes. So just number one, if you look at the very quickly, all the individual borrowers are out of it. Individual borrowers for business are out of it. MSCs up to 7.5 crore are out of it.
Yes.
All the large borrowers in any case, I mean, the general practice, when the interest reset is due for their loan and floating loan, they always have a prepayment option, either with no penalty or with a very notional penalty. That is the reality. It means it leaves only a segment of MSME at about 7.5 crore and medium enterprises.
Okay.
I don't know why. So that is why I was talking about discrimination and inconsistency. So I will be very quickly, I will have a 3 asks. Number one, it should be uniform across the borrowers and the lenders based on principle. That is number one. Number two, to my mind, now lock-in period is waived in this draft circular. I think there should be a reasonable lock-in period which should be permitted so that the lenders are allowed to do a more consistent business planning.
Okay.
It should not be, very strict, but there should be a reasonable lock-in period, which should be. And the third point, I would say reasonable prepayment penalty can be allowed, because when you get the prepayment and before you redeploy, theoretically the money is invested in treasury operations, which yield little less. And a loan, when it is given, also involves administrative and operational costs. So something which is very, very, reasonable, only covering this kind of cost may also be considered. So I would say these are the 3 asks I would have in my mind.
Okay. Well, thank you very much, Mr. Mundra, and I hope the message is heard and you will write to the Reserve Bank before March 31st. But the key takeaways from the other gentlemen on growth itself is, even as Mr. Mundra pointed out, this is not an all-out signal. After all, the risk weight on unsecured loans has not been lowered. So Nikhil Gupta not changing his growth forecast just yet, considering the, of course, huge headwinds from the tariff issue itself and other growth constraints. Suresh Ganapathy also not changing any of his EPS or net interest margin forecasts for the companies that are being tracked. Nevertheless, the market in a slightly happy mood after these announcements. Thank you very much for joining us with your 360-degree perspective, Nikhil, Suresh and Mr. Mundra. And thank you everyone for watching Indianomics.